Welcome everyone to Life Insurance 101. This is our Zoom class review. And we're going over our study guide today, which includes the most commonly asked questions from Pass Now, You Can Pass, Quizlet, all that just merged into one. These are some of the most testable questions that you may very well see in some form or another on the concepts on your exam. Now, even though we're using the study guide, I do want you to continue to use your study plan, and that is you going into your POL, Primerica Online, or the app, and taking the quizzes for each chapter for the set number of times. Also, remember to take a practice test. It is crucial that you try it out, see what it looks like. It's going to give you a real good feel of the real test, okay? Now, what I'm going to do here today is I'm going to break down these questions. We're going to talk about them. I may ask for a little input from you. If I do, then please unmute and share with the group. Even if this is not live and you're watching the recording of it, I still want you to participate by sharing what you're getting from the questions that I'm asking. Now, we're going to look at them and decide, okay, is this a definition question, a fill in the blank question? Is it just something I need to memorize? Are they trying to trick me? What's the real deal? What's the real question? What are these answer choices all about? Why they put that there? All that. We're just going to break it down. This is a breakdown session. Break it down, break it down. Okay, sorry. All right, number one. Statements by an applicant concerning personal health history, family health history, occupation, and hobbies are referred to as representations. And you'll notice that the correct answer is already denoted with the diamond. Okay, so it's not about the answers right now. It's about how they're setting this whole situation up. So if you look at it, it says statements by an applicant. Basically, this is a definition question. What are representations? Representations are statements by an applicant. Boom. If you know what that is, then you got it. That's your key word because you know the definition of representations. Personal character. The rest of that stuff is just fodder. Nothing on here is tricky on this question. Number two, mortality is based on a large risk pool of people in time. Mortality, we're talking about the number of people that die over a period of time. So mortality, people, and time. Number three, the purpose of the spendthrift clause in a life insurance policy is to prevent the creditors of a beneficiary from claiming any future death benefits payable to the beneficiary. They can't just come knocking on your door saying, hey, I heard you had some money coming. Don't forget you owe me. No, sir, you can't have none of that money. That money is protected by the spendthrift clause. Remember, spending, you're putting out money. You're spending it out. Thrift, you're saving. If you're thrifty, then you're saving money. So the spendthrift clause saves you from spending out money with the creditors. Right? Which of the following, down here, number 4, which of the following is a provision in an interest-sensitive life policy, which allows a policy owner to withdraw the policy's cash value interest-free? So this is an interest-sensitive policy, and it has cash value, which means it's a whole life policy we're looking at. And if we're withdrawing if we're withdrawing the money from the cash value, but we're not canceling the policy, then that's going to be partial surrender. We're partially surrendering a part of the policy by taking out some of the money. All right. Purchasing insurance is an example of which of the following methods of handling risk. Purchasing insurance is an example of which of the following methods of handling risk. Okay, so first of all, Insurance is the what of risk? Go ahead and unmute. What is insurance? Insurance is the blank of risk.
Transfer.
Transfer. Right. So that's going to be our answer. Purchasing insurance is an example of transference, which is a method of handling risk. Transference is one of those things that's on our STAR, STARR. So if I've got my brain dump sheet sitting next to me and I'm thinking, oh, okay, purchasing insurance is an example of which of the following methods of handling risk. Ooh, handling risk. There's an acronym for that. Let me look at my cheat sheet. It says STAR, STARR. Look, there's transfer. I know insurance is the transfer of risk. They must be talking about transference. See how that works? All right, number 6. The Commissioner of Insurance may suspend any insurance producer's license for all of the following reasons, except, all right? So when we're looking at an except question, we want to think about what are they saying before they get to the word except. All of the following except, okay? All of the following what? Reasons. They're looking at the reasons. The reasons that a commissioner of insurance can suspend your license. So three of these are reasons that they can suspend your license. One of them is not. You can put a finger down in insurance edition if you like. So if you put up 4 fingers, you say, okay, so what can the commissioner suspend my license for? Can they suspend me for soliciting insurance in a neighboring, adjoining state? Not if I got a license in that state, so no. Soliciting insurance is a part of my job. Not going to get suspended for that. Keep a finger up. Violation of any insurance law of this state. Okay, violation is a bad thing. I'm assuming that if my license is getting suspended, it's for something that I did wrong. So violation, put a finger down. Obtaining a license through misrepresentation. Misrepresenting. That's not good. That's bad. So I'm gonna put a finger down. All right. There's got to be 3 bad things and 1 good thing. Materially misrepresenting. Now now you're getting deeper in your misrepresentations. Those are falsehoods. So we're gonna put a finger down for that. So then we should have 1 finger up, and that is for our answer: soliciting insurance in an adjoining state. That was a lot to go through, but it's a 2-hour test. It's timed for 2 hours. You got plenty of time to do it. All right. The primary use of an annuity is to provide funds for retirement. Life insurance provides funds for an estate. Annuities provide funds for retirement. The process by which an insurer decides to whom to issue a policy is known as, I just love reading that, the way they put those words together. The process by which an insurer decides to whom to issue a policy, okay, is known as. Is known as tells me immediately that this is a definition that they're looking for. So I'm going to look at my choices. Adverse selection, what does that mean? Risk classification, what is that? Assignment, what is that? Underwriting, what is that? So when you're the insurer, the insurance company is deciding who they're going to issue the policy to, that process is called underwriting. They're asking you to give them the word to the definition. So reread that as a definition. Underwriting is the process by which an insurer decides to whom to issue a policy to. Okay. A and B are just part of the underwriting. Adverse selection, that's a part of the process. Risk classification is a part of the process, but it's not the name of the process. Okay. Assignment, they just threw that in there. That has nothing to do with underwriting at all. All right, next. Before receiving an insurance license, An applicant must swear an oath before a judge. No. You know how many people would be swearing an oath before a judge every single day with all the licenses people are trying to get? That's too much to do. Provide a copy of the high school diploma. Don't nobody care if you graduated from high school. Remember, RVP Basil Page has an 8th grade education. He's an RVP, a 6-figure earner, blah, 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 all of this, great business. He doesn't have no high school diploma. Nobody cares. All right. Put up a $10,000 bond in case of wrongdoing. So you telling me, okay, I got into this business to make $10,000. I ain't got $10,000 just sitting around to give to you so that you can hold it in case I do something wrong. And then if I never do anything wrong, you're just gonna keep holding it until I do something wrong, and then you'll keep it. That don't compute. So our obvious answer here is pay a license application fee. It's the most simple and reasonable thing to do. Fill out the application, pay the fee. That's it. Number 12. And these numbers have nothing to do with nothing, so don't worry about the numbers or the order of the answer choices. We're just breaking it down. Break it down, break it down. What is the purpose of a grace period in a life insurance policy? Well, let me ask you this. What is a grace period? Boom. It's a definition question, right? A grace period prevents the unintentional lapse of a policy. That's the purpose of it. That's what it does. Okay. It's that period of time between when the policy was actually due and when we gonna cut you off. Okay. Everybody needs a little grace. All right. Miss the mark, and you just need a little grace to get it corrected, to correct course. All right. In order to transact business of insurance for an insurer, a producer needs to be able to carry out activities not stipulated in the agency contract. Not stipulated, not written, not expressed. This type of authority is referred to as implied. If it ain't expressed, written down, then it is implied. It's implied that you should have to do certain things based on your position in life. All right. Applied has nothing to do with nothing. That was stupid. They just threw it in as a stupid choice. Fiduciary, we know that's talking about being responsible with the client and the company's money. So the only real answer here is implied. And the only other possible answer is expressed, even though that's the wrong answer. So the answer is implied. Know your definitions. Guys, really, listen to the audio terms for success. You have it on your phone. You don't have to log into SoundCloud to listen to it. Listen to it on your car when you're driving from place to place. No more music right now. Not right now, guys. We need to listen to these definitions and terms so all this stuff becomes even more understandable. And I guarantee you that I can't guarantee you that, can I? Do exactly what I'm telling you to do, and you will pass. An insured has a 20-pay life policy, okay, with a paid up dividend option, paid up dividend option. So we're looking at our option chart under dividends. Remember, dividends are those monies that you're overcharged by a mutual company. They invest it, make a profit for themselves, and then declare, well, la-di-da, I got way too much money. I got to give you some back. Okay. Well, when it comes to the options, you have choices on how you're going to receive that dividend. This particular client decided that they wanted to apply that dividend towards their 20-pay life policy, which will help to pay up the policy early. All right. So any amount that you pay towards your whole life policy is going to help to get that policy paid up early. All right. That would explain why PASA was in such a tiff about $3 that my mother had overpaid on her policy. Next time you pay your policy, you need to pay it $3 less. That $3 is still on there. I said, Mom, what is up with this $3? Well, now we know. Now we know. Okay. Can't be paying things off early if you're not in that type of a plan. Plus, whatever money you put towards that policy is also going to grow cash value. Remember, we can't have the cash value grow over the death benefit. It can only equal the death benefit when you reach age 100. Anything earlier than that is outside the rules, and you're going to end up with some tax issues. A primary advantage of a limited payment policy over a continuous premium whole life policy is that a limited payment policy, pause, I need to hear from you. We have a limited payment policy and we have a continuous premium whole life policy. What type of policy is a limited payment policy? Is it whole life or is it term? Unmute and answer.
You said, is it whole life or is it term?
Yes.
Term.
Okay. Why do you say term?
Because it's not a long period of time.
Okay. It is whole life.
Mm.
But you are correct. It is not a long period of time for paying the policy. Okay. A limited payment policy is basically like this one, a 20-year pay policy. A 20 pay life policy is a limited payment policy. It's a limit on the amount of time you have to pay the policy up, to finish paying for the policy. So you're still paying the same amount that you would pay from now to age 100, but you're paying it in a shorter period of time. That's all they're saying. That's all that is. Okay. There's a limit on the time that you have to make the payments on the policy, but it's still a whole life policy because it is still covering you to age 100. It's the word limited that throws people off. And that was the best they could do to trick you, is to say limited payment policy. And then they come down here and they say continuous premium whole life policy. Well, they didn't have to say whole life ever. Why did they have to say whole life? They didn't need to say that. Or if they were going to say it, they could have said it for both limited payment whole life policy or just continuous premium policy. Both of those are whole life. Okay, so let me take a breath and let me reread this, okay? Because I know that was a lot. I had to interject there. So let's go back and actually read it again. A primary advantage of a limited payment policy over a continuous premium policy, whole life policy, is that a limited payment policy allows the policy owner to pay for the entire policy in a shorter period of time. Okay. We had to understand what a limited payment policy was so that we could then understand what the correct answer was. Okay. Earned income is a requirement for contributing to all of the following retirement plans except the Roth IRA. All right. So reread it again. Roth IRA does not require earned income for contributing. You might just need to memorize that one. Hold on just a second. All right. Which type of beneficiary cannot be changed without consent? It's going to be the irrevocable beneficiary. What is an irrevocable beneficiary? It's a beneficiary that cannot be changed without consent. Consent of who? Consent of the current beneficiary. All right. Irrevocable. Ear as in not, a bowl, able, not able to be revoked. Yeah. Let's see how they say it cannot be changed. Not able to be revoked, not able to be changed. This is the only one that includes the actual word irrevocable. Not a trick question. That was a good one. As a form of level premium permanent insurance, ordinary life insurance accumulates a reserve that eventually, okay, equals the face amount of the policy. Okay, let's clarify this one. Reading it again. As a form of level premium permanent insurance, right? Level premium permanent insurance, meaning that the premium does not change and it is whole life. All right. Ordinary life insurance. Okay. So what it's saying here is that ordinary life insurance is a form of level premium permanent insurance, and it accumulates, or AKA grows, a reserve, AKA cash value. So that cash value that grows in an ordinary life insurance policy, which is a level premium permanent insurance policy, will eventually equal the face amount of the policy. All right. And of course, we know that's at age 100. Okay. I'm actually going to put that there. Let me go put that there. Let me type. And let me type. It won't let me type. I'm going to go back and put that there. Age 100. Okay. We're almost through. We got about 6 more. A qualified life insurance plan is one that is approved by the insurance commissioner. Insurance commissioner has a lot of power. They're doing a lot of stuff. I would never want that job. Mm-mm. They got to govern life insurance, health insurance, auto and home insurance, um, all insurance, man. That's much. That's a lot. Number 20. An applicant for insurance policy is presumed to have an insurable interest in his spouse. Okay. Insurable interest, meaning I stand to lose something of great value if this person dies, so I need to insure their life. I don't have insurable interest on my neighbor. Okay, I'm not losing anything directly if he passes away. Of course, that might change my property values in the long run, but no. I don't have insurable interest of a friend unless they owe me a substantial amount of money that I can justify getting a life insurance policy on them. And I don't have insurable interest over my employer, even though if my employer dies, there's a good chance that might affect my employment, which would eventually affect my income, which really does kind of seem like insurable interest to me. But okay. I mean, I can. A type of annuity that provides a guaranteed accumulation or payout is called annuity certain. Just something you're gonna need to know, honey. All right. Annuity certain. It's certain to pay out. Annuity certain. Guaranteed accumulation. Certain to pay out. An insurer would consider which of the following in determining whether they should accept a group life plan. So you got a business or an association, a group of people that want to have a group life plan, and the insurer, which is the insurance company, is going to look at what? They ain't gonna look at the grace period. That ain't got nothing to do with deciding on the policy. That's after you do the policy. Beneficiary, they don't care who your beneficiary is. They don't care how many dependents you have. They are looking at the average age of the group and the ratio of men to women. Okay. Remember, we want younger people and we want more women. because men drive up the cost because they do stupid stuff, and then they have to use the life insurance. So, and this is a health insurance plan. Then we want more men because they don't use it. Betty has, okay, this is a good one. Betty has a $200,000 whole life policy with a $50,000 cash value. She wishes to borrow $30,000 for the purchase of a new van. Now you're thinking this is your money and you can just get it anytime you want for whatever you need. And you can, as long as you're borrowing it. Okay. But it's not your money, which is why you have to pay it back. It's supposed to be your money. They're going to give it to you. They just don't want to give it to you right now. So you're going to have to pay it back. All right. Because what happens if that loan is not repaid? The net death benefit will be reduced. Okay. Why? Because the insurance company never intended to pay your death benefit. No, they don't put any cash value in your policy for the first 3 years. And yes, that means that the company is on the hook for the entire death benefit the first 3 years of the policy. But that's a risk they're willing to take because they know the chances of you dying in the first 3 years of you having a policy are slim. But if you borrow money from that policy and then you die, they're going to subtract that 30,000 that Betty borrowed from the $200,000 death benefit she has, and they'll pay the family the rest. Because as far as they are concerned, you're not going to leave me on the hook for $30,000. I wasn't intending on paying $30,000. I'm only intending on paying what you don't have, not what you took out. Now you took 30 from the 50. Now you're gonna leave. Not gonna happen. Nope. Nope, not gonna do it. The settlement option that allows proceeds to remain with the insurer and the earnings to be paid to the beneficiary on a monthly basis is called interest only. Interest only. All right. What is interest only? That is a definition question. What is interest only? Interest only is a settlement option. Remember, settlement options are for the death benefit. That's on our chart. The third part on the chart, third column. You are now dead. How is your beneficiary going to receive the money? The beneficiary is going to receive interest only. Remember, I get the interest, the kids get the actual money, however that works. I don't know what I did wrong. Okay, we'll move along. Joe, this is a good one to end on, guys. Joe has a $200,000 30-year mortgage on his new home. Which type of insurance could Joe purchase that is designed to pay off the mortgage balance if the insured dies during the 30-year payoff period? That's a lot of words. Okay. Joe has a $200,000 30-year mortgage on his new home. Okay, so we know he got a mortgage. What kind of insurance does he need that'll pay off the mortgage if he dies before he pays it off? He's going to get decreasing term. Remember the Ivan Smith policy? It's decreasing term because as he continues to pay off his mortgage, then he owes less and less, right? So if he dies while he still owes on his mortgage, he ain't gonna owe the same $200,000. He's gonna owe less. So the mortgage company is only going to receive what is owed because, unmute your mic, insurance is not a
Come up.
for anybody. There you go. Thank you. Yes. Okay. So we're gonna stop right there. Thank you so much for being with us. I really appreciate it. I am here to help you all the way through. We're gonna get these licenses, right?
Yes, ma'am.
Okay. Okay, so I'm gonna meet with you again tomorrow morning and we'll go over the next set. Don't forget, you are doing your study plan and taking the quizzes each day. We're keeping our brains occupied and going each day until the day we take our test. Get your NAIC state paperwork turned in immediately so that you can turn around and schedule your test for next week or this weekend if we can get you ready. Okay?
Okay.
All right. You have a blessed day.
All right, you too.
Bye bye.
Thank you.
You're welcome.